case study is a B2B case study of an B2B auto parts company. And they are struggling to grow, and they are looking for a growth hack. So let's see what is there in store for the company. So a quick overview on the auto parts industry. So before we get into the company itself and its background and its operations and whereabouts, let's understand the overview of the auto parts industry. So the auto parts industry has experienced a healthy growth over the last decade. There might be a slump because of COVID, but they have registered a good compounded annual growth of 10% and reached $56 billion in the financial year of 2019. And the exports are also multiplying and are valued to increase to 10 billion in the years to come. The overall production also has increased, and the auto components industry is expected to reach a valuation of 200 billion by 2026. So these are some of the key indicators that the industry is doing well, and there is future, and there is a lot of opportunity in the industry. Some of the other specific growth opportunities and trends that is very important to observe is the constantly changing or shifting market dynamics, like the volatility or the forecastability in the market. Something like COVID was never anticipated, and this has completely taken a lot of businesses, sweep them off their feet. And so it's very important to understand what is happening and foresee and change. Also, the evolving adjacent industries have a huge impact on your market, so it's very important to also look at the adjacent industries. In this case, auto components case would be automobile industry that has a huge impact on their growth. And the industry is also continuously consolidating. There's mergers, acquisition happening, so that might also affect SMEs and MSMEs. So changing OEM needs, there are different needs that keep coming in, and the product cycle keep getting shorter, and the needs and the growth is continuously wavering. So technological improvements and discontinuities also need to be catered to, and looking at what are the challenges there in the sector, what is the advancement there in terms of material, or what is the next Gen Industry 4.0 sort of improvement that the industry is moving towards, and what is going to become obsolete, etc. And the evolving regulatory and trade environment also is very, very important. Looking at the emission policies, or braking policies, dynamic trade policies that are continuously changing and the government is releasing is good to keep a tab on these things. So a quick thing on XYZ. So we're just calling the company XYZ, keeping it anonymous. Is an Indian automotive components manufacturing company founded in 1994 by a person called Suresh Sikha. So he's the founder, and he's the managing founder of the company. So XYZ is a leading manufacturer of metal to rubber bonded vibration isolators in India, and they focus on high quality auto components from steel, rubber parts for auto and agricultural sector. They're a small team, a lean team of 60 employees, and they're working across various plants in India. And they supply to leading automobile companies nationally and mostly, and also internationally. So their broad product portfolio is so as an OEM supplier, they offer an extensive range of high quality auto components, and which includes automobile rubber parts, machine vibration isolators, rubber parts of agricultural sector, hoses, seals, bellows, O-rings, gaskets, etc. So, and their key features or differentiating features are that they are into custom designing. So they design based on the customer requirements. They do not compromise on quality. They are in the high quality value game, and they are application specific depending on the requirement of the customer, say in terms of size or shape or elastometer. They also manufacture based on the application of the customer. The customer base is majorly, they supply to major automobile players like Mahindra, Tata, Volvo, the Indian Railways, and also some of the public sector requirements are also also fulfilled by XYZ. And they also have customers in the agricultural sector. And the company has mostly grown domestically, and they have registered a 14% sales from export through a platform, which is a virtual B2B platform that is used to which is used for their international sales. So this is the situation. XYZ recently had its board meeting, and in its board meeting, their board of directors had set a target for the company, and the target was to increase the revenue by 70% by 2022. So that was the board's target. While this was being decided, there were a lot of other questions that came into discussion, and somehow the questions were directly pointed at the CEO and the managing director. So the questions were, why are the margins so low, and why don't we diversify to other segments? Are we in a high quality value game, and what are we doing to manage our timely delivery of raw materials? These are some of the starkly evident questions and burning questions that the board of directors had, looking at the financial statements and looking at some of the numbers of XYZ. So I'd like you to meet Pankaj Tripathi. He's the CEO and managing director of XYZ. So Pankaj is one of the early employees of the company who grew to this position. Pankaj is Suresh Sikka's, the founder's right-hand man, close confidant, and trusted employee with extensive knowledge of auto parts industry. Now, after the meeting, after the board of directors meeting of XYZ, Pankaj was feeling super lost and drained and exhausted. And he was personally assigned to delve into the situation and deeply curate a plan to achieve the 70% growth increase for 2022. And while Pankaj was cognizant that it is a difficult problem, and he had to really chart out a plan, and he was really taken aback by, he was thinking, 20 years of my career in manufacturing space, I have really not faced such a downturn in the industry, and I've not faced such a slump because of the entire COVID crisis. And how am I going to actually recover and make the board's target? So as weeks passed by, Pankaj went to the storyboard, and he was drawn into lively debates with his colleagues, various departments. A lot of heated discussions, deeper issues were discussed, and some business opportunities were also surfaced, and to strengthen the revenue trajectory until Pankaj received an email from the supplier, and which read that, we regret to inform that the order will be delayed by 2 months, and we sincerely apologize to you for the delay in delivery of the product that you ordered. And so now Pankaj knew that, the company's raw materials had been erratic, and there were constant delays in delivery of raw materials. And now he thought maybe because of this big inventory problem that they are going to face, it is time to revisit the relationship with the suppliers. So this is the entire situation that XYZ is facing. And this is like a brief summary of the entire case study in terms of the background and the challenges. And I'm going to stop here, and I'll request you to share your thoughts on what do you think would be the lagging indicators XYZ what would be some of the KPIs that from the previous discussion that we had, previous presentation, what would be some of the relevant KPIs that we need to look at for XYZ? So the first problem was definitely the undulating revenue growth, which has been which has not been stable and has been wavering up and down. So the company had registered around 28 crores of revenue in 2019, and there was a sudden dip to 20 crores, and which was down to say 26% degrowth, and they again sort of stabilized and moved to 17% growth. But now the target was to actually reach 70%, and this pattern could be because the overall growth has been fluctuating, and there has been a downward and upward trend. this probably could be attributed to the pandemic. But prior to the steep decline in 2022 as a result of the pandemic, the auto parts manufacturing industry had experienced a favorable condition, and there were strong demands for new vehicles, and that's why you see this increase here in 2019. So, and after that, the new car sales had already stalled. So the automobile industry itself was actually experiencing a stall in their sales, and which directly affected the auto parts industry as well. And so this probably explains the undulating growth rate of the company, and it is greatly affected not just by the uncertain situations, but also the trends and changes in the industry itself. So some of the factors could be, there's also high competition in the domestic market, and there's cutthroat competition, and because they're working on, they're focusing on a high quality sort of a market. It might be really hard to scale up in a situation like that. And Indian market values aesthetics and quality less compared to international markets could also be one of the reasons. So there's low focus on diversification. Major customers are from, so 88% of the revenue concentration actually comes from the major players, which is a high risk, because in case one of the players draw draw from their drawback, then they really don't have fallback options. So let's focus on other auto sectors, or even though they are actually probably very, very say high profit generating. So there's a very weak multi-channel presence as well. They're mostly focusing on physical transactions or physical presence. So having a multi-channel presence where they can actually strengthen their B2B platform and increase international sales could be one of the reasons. So high time to market, there's a shortage in supply of raw materials, delayed delivery from suppliers, and there's also a lack of moratorium from cooperative banks. So this has also led to reducing their supply to the market. There's also been a stall in the domestic automobile market, which has the adjacent market, which has directly impacted the auto parts market. So this is some of the factors that has impacted the growth. So the supply chain also was very heavily affected, and when you look at some of the parameters, so XYZ supply chain seems very complicated and convoluted, because has a range of components and parts that requires customization based on applications. So the key concern of supply chain is not just to reduce the inventory level and operating costs, but also enhance the customer satisfaction and improving the services, providing speed in terms of product delivery compared to the other competitors. So they face multifold challenges in terms of delayed deliveries from vendors, and some outsourced logistics. Tracking and inventory management was not in place. Implementation of a lean production system also was required. And so this could be grouped into, say, risk management, or cost reduction, and in general globalization. So when you look at some of the parameters like average receivable days and inventory days, so inventory days is a definite red flag, because this is higher. This is 46 days higher than the actual industry benchmark, and which means that the company is not really efficiently managing its inventory, and there's a risk of running out the stock, or missing a sale, or missing out on cost efficiencies. And the average receivables compared had bettered over the last few years, and they were standing at 63 days, but it was lower than the industry target of industry benchmark of 73 days. So which means that they're creating competitive advantage, as high accounts receivable indicates that the company enjoys high quality customer base, and it is also empowered to pay its debt quickly. So this also could probably imply that it has a very conservative credit policy. So the average payable stands at 52 days comparable to the benchmark of 56 days. So this is not a concern here, because the company has a good credit term with the supplier, and then they can maintain, or they're maintaining a very healthy working capital situation with the supplier. So some of the other reasons could be shortage and delay in raw materials, increasing cash conversion cycle and inventory days, which is very, very high here, and also low operating cash flow. So they're working on very, very thin cash flow. So the other very glaringly high cost here is the manufacturing cost, which has been very high compared to the industry benchmark of 54%. So when you look at the manufacturing cost as a percentage of the total revenue, in 2019 it was 57%, which went up 100% and it was 154%. It sort of came down to 97%, and then it is forecasted to be at 63%. But the actual benchmark is 54%. So looking at such high manufacturing costs could be because of high material cost, or it could be attached to the company's pursuit of providing high quality products. So these costs have actually shrunk the gross profit, and it's making it very difficult for the company to sustain and have a operating bandwidth. And this also really creates a threat for the cash runway in general. So some of the factors would be high quality products. So they, which means high quality raw materials have to be, sourced, and with which also increases the manufacturing cost. The gross margin of the company is at 5.2%, which is much lower than the industry benchmark of 31%. And the net profit is actually running on negative, which is which is probably worse in the industry conservative average of 2% itself. So looking at the profitability assessment, two main KPIs, gross margin and operating margin. So the gross margin has been also at has been stabilized over the last few years, which is at 4% to the next 2 years it has reached to 5%. But the actual industry average is 31%. So there's a lot of climbing to do in terms of margin. That could probably be because of the high manufacturing cost as well. And the operating cost is actually running on negative, which is at a negative at a loss of 10%, and then it had sort of gone up to 4%, but again it dropped to a negative 11%. So the average benchmark for the industry is 5%. So looking at some of these numbers, there's a need to actually look at how to transform some of the parameters and make some quick changes in their systems. So the liquidity and the liquidity assessment would also include asset ratio and cash conversion ratio. So some of their the asset ratio and cash conversion ratio sort of the working capital ratio and the asset conversion ratio are sort of comparable to the say the industry benchmark, but the cash conversion ratio is actually again very glaringly high, and it reflects that the number of days cash takes to move from payment to supply collection is very high, which is 52 days, and the benchmark is actually 1, which is a very far target for XYZ right now. So now the situation is Pankaj's top priority was to make the revenue target expectation of 70% increase, and he had to strategize to diversify and expand, knowing that it would further put pressure on the inventory process. So with the business slowing down, and he had to really act quickly, resolve the supply chain issues, reduce cost, increase the revenue of his cash-strapped business. So some of the questions that he had to answer and look at was, should the company's effort focus on further growing in the auto parts sector, or was now the opportune time to actually aggressively extend to other sectors, agriculture or non-auto sectors? What strategies and tactics would be best for the future, and are there any risks associated? Would there be any cannibalization, or would there be would the company lose focus from auto parts, and would they lose their customers because they move to other segments? Was also a huge question a strategic question to answer. So some of the key strategic options would be market segmentation, diversification. It is recommended the company explores business opportunities in other non-auto sectors because they were getting great traction in the agriculture sector. The customer acquisition suggested to focus on acquiring the two-wheeler market through OEs and aftermarket segment also. So that will also give them a broader bandwidth in the auto parts sector itself. Also geographically being more diverse, which would be leveraging on the international markets, and also where premium prices can be charged, should be one of the strategic options that they could look at. And multi-channel presence, having an online platform and strengthening their presence internationally to to accelerate the exports as well. So now in terms of efficiency, cost reduction opportunities had to be discussed. Should they look at multiple vendors or neutralize the risk of neutralize the risk of delivery and delayed delivery? Should they maintain a safety stock or fallback in case of delays and shortages? And is the lead time too high? So these are some of the questions, and key options that they could probably implement was having an inventory management system to forecast, track, and audit the inventory levels, calculate how much stock to order and raise purchase, and what time and what is the right time to actually raise purchase order, and educate the warehouse staff on correct inventory handling, because it is very important when human resources are involved, and proper training of employees on company procedures to shorten the lead time, and focusing on how to generate cash from operations every year, reducing receivables that appear in the books by collecting advance or collecting them quicker. So assessing the supplier or looking, so the cost strategy would be looking at some inbound logistic which is too high, or looking at ways to reduce the material cost, or looking at production wastage. Is it too high, or is it too much being wasted during the production process? And is the quality, is the cost of quality too high, and are we in the wrong high quality value game, and should we look at a different market altogether? So reducing cost, some of the key options here would be to reducing cost, material cost definitely, and assessing the suppliers relationship and exploring alternative providers could be one of the options. Cutting down on other overhead costs and expenses, because there could be other glaring costs that are actually not contributing to the actual productivity, and improving the overall turnover and sales of the company by diversifying to other segments and improving the product offerings.